Dividend paying whole life insurance is a safe and stable asset to own during tough times. Hello friends, I'm Barry Page with Legacy Money, and in this video I'm going to be discussing the current financial crisis, what you can do to prepare and profit from the opportunities that will follow. And I'll be discussing questions that I've been getting about rising interest rates, inflation, and how these things will impact life insurance and infinite banking policies. We'll also explore the impact of the crisis on mutual insurance carriers and whole life insurance. This includes some serious implications for you and your financial future. You'll notice I'm in the studio today with headphones and a mic because there's some outside interference going on. But also I will be reading some of the text just to make sure I get the verbiage correctly. First off, let me say that I'm not trying to say I told you so, but I have been warning about a financial collapse for over a decade now. It gives me no peace to share this information with you, but I do want to be a voice of reason, and I do want to share with you the true benefits of whole life insurance from a mutual life insurance carrier. As I speak, we are witnessing some of the largest bank collapses in recent history. Unfortunately, it's only going to get worse. The good news is there are going to be opportunities for those of us that are ready. I'm an optimist and tend to have a positive attitude. However, most people, I feel like, are not paying attention. So I feel like I have to warn people about the dangers that we all could face. And when I say all can face, this is going to impact everyone, just like the pandemic and just like past recessions and depressions. Anything that I say or suggest is purely speculation, and it's the same with anyone making predictions. It's all speculation. However, we all have the choice of discerning the truth and considering possible outcomes for the future based on history. And instead of believing in unicorns, I tend to look at reality. The point is, there are economic powers and certain things that we do not have direct control over. But at least for now, we can take control over how we spend our money and how we save our money. What's the difference between life insurance companies and banks? Let's turn our attention to dividend paying whole life insurance and the infinite banking concept. My experience comes from being in business almost 40 years. In business, you tend to look at profits and expenses. And it's not hard to figure out if you spend more than you earn, you're going to have to incur debt just in order to pay your expenses, or either not pay them and default. As a country, we've been at this point for quite some time. Fortunately, when I started in this current business, I was blessed enough to meet Nelson Nash, the best-selling author of Becoming Your Own Banker. I was immediately drawn to him because of his wisdom and his knowledge of the Bible. He also introduced me to Austrian economics. And when it comes to money, I tend to listen to people with experience and those who favor the Austrian economist's point of view. That is, we believe in practicing responsibility, and we believe in financial independence, and that we should have a sound money system. Recently, some well-known Austrian economists have been blowing the whistle loud about the financial crisis that we find ourselves in. Peter Schiff laid out the new bailouts and how they will work. He said the banks will now be able to go to the Fed and get money when they need. He said inflation will get much worse and more money will have to be created. He also says the banks are the riskiest place to leave our money now. Robert Kiyosaki and his recent guest Andy Schectman said bailouts have basically become bail-ins and will become the new norm. Deposits will become investments, and depositors will become unsecured creditors. This has already happened in Cyprus, folks. Here in the U.S., though, we're borrowing money to fight wars, and we're not taking care of things here at home. Our money is being devalued by excessive government spending and money creation by the Fed. So let's take a look at some history, and specifically the Great Depression. You may remember the Christmas movie It's a Wonderful Life with Jimmy Stewart. Well, in the movie, there's a run on the bank. So let's talk about bank runs. This is from Robert Murphy. By the very nature, fractional reserve banks are vulnerable to runs. This happens when mass amounts of depositors seek to withdraw their funds. Let's say a bank takes in $100 in a cash deposit, but only keeps $10 in reserve or the vault. Well, that's really all that's required, and it's even more or less now because of bank laws. But the other $90 can be lent out to others or invested by the bank. Fractional reserve banking leaves the depositors vulnerable to a run. If the original depositor who thinks he has $100 in his account wants to withdraw his money, the bank should be able to accommodate this under normal circumstances. But because even though the bank has loaned out $90 of his initial deposit, there are other depositors that might be depositing funds. So the bank can use their funds to allow the withdrawal of the $100. That's under normal circumstances. The problem comes when mass amounts of customers show up to withdraw funds, hence a bank run. This happens when there is fear. And if you just take a look at consumer confidence recently, there's not a lot of confidence in the banks or the government. In the early years of the Great Depression, there were many commercial bank failures. There weren't as many life insurance companies that failed, but there were failures in the life insurance industry. During this time, people turned to their life insurance for access to cash. Like the banks, the insurance companies were faced with the possibility of runs as well. So, of course, the government stepped in. On March 9, 1933, New York Superintendent Van Schaik issued the first regulations following a meeting with representatives of the leading life insurance companies. Insurance companies were prohibited from paying cash surrender values or granting policy loans on cash, although each policyholder could obtain up to $100 in the case of dire and demonstrated need. Policyholders could not withdraw any sums they had left on deposit with the company. However, insurance companies were strictly encouraged to continue payment of death claims, annuities, and matured endowments. And on September 9, 1933, all restrictions on policy loans and the payment of cash surrender values were removed just 6 months after they first were imposed. Today, life insurance companies are regulated by the states and required by law to keep ample reserves. Generally, life insurance companies' reserves are held to supplement the future premium receipts when the latter alone are insufficient to cover the increased risk in the future years. It can get pretty convoluted because there are a lot of types of companies, stock and mutual companies, and there are different types of reserves and assets that qualify as reserves. Statutory reserves are the funds that state insurance regulators require that insurance companies operating in their state must maintain at any given time. We'll cover more of that later. Primarily, these reserves are to ensure that sufficient cash flow on hand can satisfy the claims made by the customers. Reserves are also required to maintain and to provide for ordinary operating expenses of the business if this business were to continue, things such as taxes, salaries, and commissions. However, there are variables that could cause other problems. For instance, insurance companies often use reinsurance to spread their risk. If one company has reinsurance with another company that's insolvent, the reserves from the other company could come into play when determining its financial reserves. Insurance companies also typically invest a portion of their capital in bonds and other investments. And although most of these are very conservative, there is risk involved. In discussing dividends and statutory reserves, Carlos Lara had this to say. Policy owners own a mutual life insurance company. Mutual companies do not have stockholders, they have policy owners. Policy owners share in company profits through dividends paid on their policies. The policy owner in a mutual company has a special interest in this surplus. Statutory laws play a key role in determining the surplus's divisibility. It is in the excess of an insurer that has accumulated at the end of the year, establishing statutory policy reserves and other liabilities of the company. Due to the heavy influence of statutory reserves and accounting procedures, this profit surplus is more appropriately understood to be statutory surplus. Divisible surplus, once we understand its true meaning, quickly becomes one of, if not the most important element of a mutual life insurance company, simply because it represents the company's profits, its gain from operations. This profit is the aggregate amount of gains coming from four specific areas: gains from investment earnings, gains from mortality, gains from loading, gains from surrenders. Gains from mortality, loading, and surrenders are actually expense savings from each of these three anticipated operating expenses of the company. Therefore, that's how the dividends are paid. Okay, let's talk about inflation. Is the dollar collapsing? And how does that relate to infinite banking? The US dollar is the most stable and sellable asset of exchange. Look, when we buy real estate or any other asset, we don't worry that it's based on the dollar. If you have a business, you don't worry that you're using dollars as the medium of exchange. All right, what about the collapse of the dollar? Now, I don't think this is going to happen, but it could. It's certainly a risk. If the dollar collapses and we have a new medium of exchange, what happens is things will be repriced. It doesn't matter if it's infinite banking, life insurance, your home, or any other asset that you own. Nelson Nash often would say, whole life insurance built this way, meaning the IBC way, is a natural hedge against inflation. So what do interest rates mean for infinite banking? Nelson Nash also said IBC was a way to have your own personal monetary system. And he always said that interest rates were not the issue. It was the volume of the interest that we pay. So when it comes to interest rates, again, this is something that we cannot control. But we can control our life insurance policy and how we treat it when it comes to the banking function. Here are a few more interesting tidbits. Banks use gold and BOLI, bank on life insurance, as their tier 1 assets. The FDIC recommends that banks own life insurance for safety. Our money, our wealth, has to reside somewhere. And if it's not with the banks, then where else? Your house? Crypto? Perhaps a coffee can under your bed, your mattress? What about the stock markets? Are you confident in storing your wealth in these places? Remember, wherever wealth is accumulated, someone will try to steal it. Life insurance companies keep our money safe so we don't have to. And personally, I like doing business with like-minded people. Now that we've covered the problems, let's talk about the opportunities. First, let's take a look at some of the banks. Goldman Sachs, JP Morgan, and the other large banks that have stepped in to buy the debt from these smaller banks. Think about that for a minute. Thinking in those terms, what if you had the capital reserves to buy debt? Currently, there is an abundance of businesses that service large amounts of debt. They need cash flow to operate during these times in a more efficient manner. You'll obviously want to educate yourself by researching the markets and the types of debt you may want to buy. But if you have experience with a specific kind of debt or a particular debt class or contracts, perhaps you have an affiliation with someone looking to sell debts. For instance, your county and property taxes. Another example is Amazon. In early 2000, this young online bookseller sold $672 million in convertible bonds to shore up its financial position. Just 1 month later, the dot-com bubble burst, and many of Amazon's e-commerce rivals went out of business. They were ready to survive and strive even during this recession. When a recession hits, there's less cash coming in, and there's more risk of defaulting. Businesses with more debt are often forced to cut costs and have layoffs. These cuts reduce productivity and restrict growth, leaving little room to invest in opportunities. How about the stock market? Recessions are often accompanied by more problems. People have to sell their stocks. Stocks go on sale. And just like job losses, there will be market losses and fire sales. Stock values often decline, which may be bad news for existing stockholders, but good news for new investors. It seems more and more people are interested in real estate investing. and there will be opportunities during a recession. But like any other investment, it's important to have knowledge and to understand the risk involved. That's where owning our debt becomes more important, and perhaps owning a whole life insurance contract. Loans can be taken against the policy to purchase other assets. Solvency is much different than debt. When we're solvent, we have the capital to pay the liability, but may choose not to because of arbitrage or other reasons. Buying opportunities may be greater during a recession or crisis, but they should be approached with caution and should only be considered if you're in a good financial position and if you have the right attitude and knowledge. You should never compromise your financial security for a risky investment or opportunity. If you're suffering financially, there is no shame in missing out on opportunities. That's all for today, folks. Thank you for joining me, and if I can help you in any way, let me know. Please leave your questions and comments below, and if you haven't already, I'd appreciate it if you subscribe to my channel, and I'll see you in the next video.